Welcome back to Financial Market Insights for Traders. I'm your host, Sophia. Today, I want to talk to you about something that sits right at the heart of how people approach markets, yet causes a lot of confusion, especially for newer traders and investors. That topic is macro versus fundamental investing. This isn't just a theoretical debate. How you understand macro versus fundamental investing will shape how you read the news, how you react to market moves, and how confident you feel when prices don't behave the way you expected. I want this episode to feel like a conversation, not a lecture, because this is one of those subjects that clicks best when it's explained calmly and practically. So let's start with the big idea. When people talk about macro versus fundamental investing, what they are really talking about is perspective. Macro investing is about stepping back and looking at the entire system. Fundamental investing is about stepping closer and looking at the individual parts. Neither approach is inherently better. They simply answer different questions. Macro investing starts with the belief that markets are driven by large forces. These are forces that don't care about one company or one stock. They care about the economy as a whole. Things like inflation, interest rates, central bank policy, government spending, elections, wars, energy prices, and global trade all fall into this category. A macro investor wakes up thinking about questions like where inflation is headed, whether central banks are likely to raise or cut rates, which economies are accelerating and which ones are slowing down, and how capital might flow as a result. They are thinking in terms of themes and cycles rather than individual balance sheets. When a central bank raises interest rates, for example, it doesn't just affect one company. It affects borrowing costs across the entire economy. It impacts currencies, bond markets, stock valuations, housing markets, and commodities. Macro investors try to position themselves based on how these forces interact with one another. Because of that, macro investing is often expressed through broad instruments. Instead of buying individual stocks, macro investors may trade entire stock indices, government bonds, currencies in the forex market, or commodities like oil and gold. They may use sector or thematic ETFs to express views on economic trends rather than company-specific stories. This approach can be especially powerful during periods of change. Think about times when inflation is rising quickly, when central banks are tightening or loosening policy, or when geopolitical events create uncertainty. During those moments, the big picture tends to dominate market behavior. But macro investing isn't easy. Economic data is often backward-looking. Markets frequently move before the data confirms anything. Central banks don't always communicate clearly, and political decisions can come out of nowhere. That means macro investors need to stay flexible and well-informed. This is also where having the right tools matters. Acting on macro ideas requires access to multiple asset classes, real-time data, and clean execution. Many traders look for a world-class, cutting-edge, user-friendly trading platform app that allows them to implement macro strategies without friction. One platform designed with that in mind is Crystal Ball Markets. If you're curious, you can explore it yourself by visiting crystalballmarkets.com/platform and see how it supports trading across different markets from a single environment. Now, let's shift gears and talk about fundamental investing. If macro investing is about stepping back, fundamental investing is about leaning in. It's about understanding the actual businesses behind the ticker symbols. Fundamental investors believe that companies have real value based on their financial performance, competitive position, and long-term prospects, and that markets don't always price that value correctly. Fundamental investing involves digging into revenue growth, earnings consistency, profit margins, cash flow, debt levels, and balance sheet strength. It means looking at management decisions, corporate governance, and how a company fits within its industry. It's about asking whether a business has a durable competitive advantage, whether it can raise prices without losing customers, and whether it's positioned to grow sustainably over time. The goal is to estimate what a company is truly worth and compare that to its current market price. If the market price is significantly lower than that estimated value, a fundamental investor may see an opportunity. This approach is often associated with longer time horizons. Fundamental investors are usually less concerned with daily price movements and more focused on where a business might be in 5 or 10 years. That doesn't mean fundamental investing ignores the broader environment. Economic conditions, regulation, and interest rates all affect companies. But the focus remains on how those factors translate into business performance rather than on the factors themselves. Learning how to think this way takes time. Financial statements can feel intimidating at first, and valuation concepts don't always come naturally. That's why ongoing education is so important. Podcasts, in particular, are a great way to build understanding without feeling overwhelmed. If you're interested in beginner friendly discussions on trading, investing, macro, and financial markets, the Crystal Ball Markets podcast series is a useful resource. You can find it by going to iss.com/podcast/crystalballmarkets, and it's designed to make complex ideas more approachable. Now, when we talk about macro versus fundamental investing, things really come to life when we look at how each approach behaves in real market conditions. During economic expansions, macro investors may increase exposure to equities, growth-sensitive assets, or cyclical sectors. They are positioning for broad-based improvement across the economy. Fundamental investors, during the same period, may focus on companies with strong earnings growth and expanding margins, looking for businesses that can outperform even within a rising market. During recessions or financial crises, macro investors often shift toward defensive assets. They might reduce equity exposure, move into government bonds, or increase allocations to assets like gold. Fundamental investors, meanwhile, may look for high-quality companies whose share prices have fallen due to panic rather than deteriorating fundamentals. In periods of high inflation, macro investors pay close attention to central bank responses, interest rate expectations, and inflation-sensitive assets. Fundamental investors focus on which companies have pricing power and can protect their margins as costs rise. Both approaches are responding to the same environment, but they are interpreting it through different lenses. Each style has its strengths and weaknesses. Macro investing offers a powerful framework for understanding market direction and managing portfolio-wide risk. It allows investors to express views on global trends rather than betting on individual companies. But it also relies on forecasts that can be wrong, and markets often move in ways that surprise even experienced macro traders. Fundamental investing encourages patience and discipline. It's grounded in measurable data and aligns well with long-term wealth building. But stocks can stay undervalued longer than expected, and company-specific risks can emerge unexpectedly. This is why many professionals don't choose between macro and fundamental investing. They combine them. A common approach is to use macro analysis to identify attractive regions, sectors, or themes, and then apply fundamental analysis to select the strongest companies within those areas. Macro provides context. Fundamentals provide precision. Together, they offer a more balanced way to think about markets. In today's fast-moving environment, having a clear framework matters more than ever. Ideas are everywhere. Information is constant. What separates consistent traders and investors from the rest is structure, discipline, and the ability to act effectively on their views. That's why platforms and education go hand in hand. A trading platform like Crystal Ball Markets, designed to be cutting-edge and user-friendly, helps traders implement ideas efficiently, whether those ideas are macro-driven or rooted in broader market analysis. Again, if you want to explore that, you can visit crystalballmarkets.com/platform and see how it fits your style. So when it comes to macro versus fundamental investing, the real takeaway is this. One approach helps you understand the forces shaping markets. The other helps you understand the value of individual businesses. One shows you the landscape. The other helps you choose where to stand. You don't need to master everything at once. Start with one approach. Learn it deeply. Add the other as your confidence grows. Markets will always be uncertain, but understanding how macro and fundamental investing work gives you clarity, perspective, and a stronger foundation for decision-making. Thank you for listening to Financial Market Insights for Traders. I'm Sophia, and I'll speak to you again in the next episode.